CEO of BioCT, and BioCT is the voice of the bioscience industry in Connecticut. Before we get started, I'd like to go over a few housekeeping issues regarding Zoom. Only the panelists will have audio and video. Today's webinar will have a Q&A format. You will have the opportunity to submit text questions to today's presenters by typing your questions into the chat icon on your screen in the bottom area. We encourage you to send your questions, excuse me, at any time during the presentation, and we'll address them either during or at the end of the presentation. And please note that the presentation today will be recorded and available for further review. So at the moment, I'd like to invite David Campbell, who's the Vice President of Business Development at Advanced CT, to say a few words.
Great, good morning. Thank you, Dawn. It's a pleasure to be able to help you again with another great webinar. You've got a fantastic lineup of speakers with a fantastic moderator. We at Advanced CT are a statewide member-funded nonprofit private sector organization. We do three main things to benefit the state and the economic well-being of its residents and companies. Firstly, we recruit companies, startups, and technologies to the state. And secondly, we work with companies already present in the state on retention and expansion. We've got a lot of work to do. We know a lot of companies are suffering, and we're here at any time if we can be of a help to you. With that, we've got a great lineup, so back to you, Dawn. Thanks.
Thank you, David. And now I'd like to introduce our moderator, Mostafa Analoui. He is the Executive Director of Venture Development, Office of the Vice President for Research and the Technology Incubator Program at UConn. While at Pfizer, he was site head for Global Clinical Technology in Groton and New London, a division focusing on emerging technologies for development and validation of biomarkers and diagnostics for drug development. Prior to joining Pfizer, he was the Director of Oral and Maxillofacial Imaging Research, Associate Professor of Radiology at Indiana University, and Associate Professor of Biomedical Engineering and Electrical Comp Engineering at Purdue University. He was also President and CEO of Therametric Technology, Inc., and he received his PhD from Purdue University, followed by a postdoctoral fellowship at IBM T.J. Watson Research Center in New York. So, without further ado, I will now turn it over to Mostafa. Thank you.
Thanks, Don. Good morning, everyone. It's my pleasure to moderate today's panel. Some of you may recall exactly a month ago, we had another panel that brought together the CEOs of companies developing therapeutics, diagnostics, and vaccine for COVID-19. And one of the key questions that kept coming back during that conversation was the investment landscape. What's happening there? And what do we know? And what should we be doing now? But things are changing so rapidly, I think any comment that we made a month ago probably needs to be updated today. And that's probably the case for today. As we look at investment landscape, there are generally two components. One is on the public investment, the other one is on the private side. Public investment is a different beast. We are going to set aside, unless we talk about IPOs in this discussion, we are focusing on the private investors for the innovative startups and late stage companies. It is definitely a pleasure to have a very diverse set of panelists from California, San Francisco, Bay Area, all the way to Boston, as well as Connecticut. And in addition to geographic diversity, they have coverage from very, very early stage, the seed level angel investment, all the way to the Series A, B, and the capital markets at IPOs. So this is a very unique opportunity for us to look into what we see at this stage. Where is the private investment relative to early and late stage startups? Although most of participants have biotech flavors, some of these funds invest both equally in technology as well as life sciences, so that the comments would be relatively broad. As Dawn mentioned, you should be asking your questions through the chat button. All the audience are expected to turn off your camera as well as muting yourself so you can see the panelists throughout the conversations. Please do not text me or send me email if you have any question. I have no way of checking those while we are having discussion on the panel. With that in mind, what I'd like to do is ask the panelists to introduce themselves, their firms, what they do, and what areas do they specialize. And we start with Jonathan Norris. John, please.
Great, thanks, Mostafa. Yes, Jonathan Norris with Silicon Valley Bank, which is a commercial bank, and really we focus on working with early stage companies from idea on a napkin all the way through venture funding into the public market. If you have any companies that are have some sort of secret sauce technology, those are the type of companies that we want to interact with, and we've been doing that since the early 80s. We have 26 offices nationwide. We have offices also in China and Israel, the UK, as well as Germany now. And I manage the life science venture relationships for the bank. I do that mostly on the West Coast. I have 2 colleagues that do that on the East Coast as well. So I'm interacting with the venture folks on sort of a daily basis, talking about how to deploy capital and how we put, and how they're putting their dollars to work. And so, as a backdrop to that, I author a couple of papers that we put out, twice a year that sort of focus on investment and exit activity that we see in the healthcare venture markets. And great to be here today. Thanks, Mostafa.
Thank you. Colleen, go ahead, please.
Sorry, if I can say one thing just logistically. If you guys want to, all the audience, click on speaker view, then you will get full face of the panelists speaking. Thank you.
David, we don't need the slides yet. Thank you.
Don gave that tip just in time for me to be huge on everyone's screen now. Thanks. Anyway, pleasure to be here. I'm Colleen Cafaro from Canaan Partners. I'm a partner out on the East Coast. So we're a traditional venture capital firm that's been around since 1987 and started here in the state of Connecticut. We still have an office in Fairfield County in Westport where I'm based, but we also have 3 additional offices, 1 in New York City and 2 out in California, San Francisco, and Menlo Park. We are now on our 11th fund, which is $800 million, and we're one of the few remaining funds that is still diversified in that we invest in both tech and healthcare out of the same fund. We're early stage investors, so the vast majority of what we do is seed and Series A investing. We're very active. We usually lead or co-lead and almost always take a board seat. I sit on the healthcare side where we invest in mostly early stage biopharmaceuticals. So those are usually, as I said, seed or Series A investments and often preclinical at the time of our initial investment. My own personal background, I'm a scientist by training. I did my PhD at Yale in the Department of Cellular and Molecular Physiology. I started my career in industry working as an analytical chemist at a small contract pharmaceutical manufacturing firm where I worked on everything from preclinical feasibility work through commercial drug supply, and then joined Canaan 6 years ago and personally focus entirely on early stage biopharma. It's a pleasure to be here and I look forward to the discussion. Thanks.
Thanks, Molly. Colleen, I forgot to, how many billions of dollars you guys have asset under management? Was it 2, 4, 5?
5 now.
5. And it's growing. And so it's very unusual to see early stage investors of that size. Typically, they gravitate, as the size of funds get bigger, they gravitate away from the early stage. And that's a good thing to have these days. Now, just a reminder to the audience, please turn off your camera so you can see the speakers as they come on the screen. Moving on to Cindy Green. Cindy, please.
Yeah, hi, good morning, everybody. Thank you for inviting me to be part of this panel. I am representing Connecticut Innovations, which is a quasi-Connecticut state fund that does primarily early stage. We invest in both technologies as well as pharmaceuticals, diagnostics, pretty much across the board. I have been with Connecticut Innovations only 1 month now. So I was consulting with them for a while, but most recently I was at Pfizer in the business development group, heading up search and evaluation for anti-infectives and vaccines. So definitely an exciting time, not in a good way for me right now. Connecticut Innovations basically is there for Connecticut entities. So since we are a state agency, our primary goal is job growth, as well as portfolio growth. And we can talk a little bit more about that in the Q&A.
Thank you, Cindy. For disclosure, I must disclose that I sit on the board of Connecticut Innovation. Moving on, let's see. Chris, did I skip you?
Maybe I'm next.
Well,
want me to give a
Chris,
background?
Go ahead. See,
Yeah, sure.
That's the challenge of multitasking. I told people, don't text me while we're on the panel. Go ahead, please.
No worries. Chris Garabedian. I have about 28 years in biopharma, working at operating companies like Gilead. Celgene was the public company CEO of Sarepta. A few years ago, I started Xontogeny. I would currently serve as the CEO of Xontogeny, which is, I describe as an accelerator. We incubate and do seed investments in early stage biotechs. But importantly, we like to partner with entrepreneurs, scientific founders, first-time CEOs, because we bring a team of experienced, pharmaceutical drug development and technology folks to help really actively manage those. But I also joined Perceptive Advisors, which is a $5+ billion life sciences fund. They do public equity investments, crossover investment. They also have a couple credit funds. But I joined them to launch their first venture fund to focus on early stage Series A investments. So we can do seed investments and provide a lot of management support. We can also do larger Series A investments, but we like to describe ourselves as middle market, that you're unlikely to see us do a 50 or 80 or $100 million Series A round. We like the 10 to 20 million. We can go higher, we can syndicate, but we really are focusing on getting a lead asset into the clinic and through a clinical proof of concept study. So really happy to be here and to be part of this panel.
Thanks. Chris is joining from their Boston office this morning. Now moving on to Maryanne Rooke, that needs to unmute herself and to introduce AIF.
Hi, I'm Maryanne Rooke, and I'm president of Angel Investor Forum, which is the angel group here in Connecticut. We have about 50 members, and we invest in companies that might be pre-revenue. Recently, we invested in a company that's got $1 million a year in revenue. So we really do like Connecticut companies because of the angel investor tax credit that has been in place for about 7 years. We meet normally at Fairfield University, so if anyone is interested in joining our group and coming to a meeting, we'll be starting our meetings back in the fall. We do a lot of mentoring and advising of companies as well. Also, I wear another hat, and that is fund manager for UConn Innovation Fund. One of my angel colleagues, Joe DiMartino, and I do that, and we work closely with Mostafa and Connecticut Innovations and Webster Bank as those are the three partners in the fund. And we invest in companies that have a UConn affiliation, whether it be alum, faculty, or students. And it's a very active fund. We have about 14 investments and been in place about 3 years. And also with Angel Investor Forum, we have a fund. We're on our 3rd fund, and we'll talk a little bit more about that in the coming session. My background previously was in finance, accounting and finance. Spent 20 years in Silicon Valley. So Jonathan, we might know some of the same people. And also in Boston and now back in Connecticut, which is my home state. So thrilled to be on the panel today.
Thank you, Maryanne. As you noticed, that the spectrum of the investors to start from the very, very early stage seed investment to the classical venture crossover funds, and eventually to the public market. I want to start my first question for John Norris. And David, this is the right time to bring up your slides. John, Silicon Valley Bank has a very large full-service bank, does a number of things, but one of the stuff that I personally always look forward to looking into the quarterly and annual report that you release. Recently, you put together the biopharma investments and exit outlook. Would you please share with us the top line of your observation?
Yeah, I'm happy to, Mostafa. Thank you. And I have 13 slides, but very quickly about 10 minutes to go through just to give you a sense, and just so you know, the slides are available and you can check it out after, because there's a lot of information in there. So again, I put on a paper twice a year that looks at what we're seeing in healthcare investments and in exits. And what I decided to do with the unprecedented times we're in right now, and actually, David, you can go ahead and go to slide 2, is really go over what we're seeing in the market. And we sort of split that off into healthcare investments, which is dollars invested into venture-backed biopharma companies, and then also talking about the exit side. So the first set of slides gives you a sense of the context of what we've seen through 2019, and then a little bit into the Q1 2020 numbers. And then we'll talk a little bit about sort of, the quote unquote new normal in this tough time, and where, at least from my perspective, where we see things going. So David, could you go to the next slide, please? So this slide just gives you a sense of overall investment in the sector. And I have a red bar around biopharma. Just a couple things to keep in mind here. One is that, in 2018, we saw a doubling of investment into venture-backed biopharma companies from about $9.6 billion to over $17 billion in 2018, and that's in the US and Europe. So an explosion of investments into the sector. In 2019, we dropped about 10% from that, but still a lot of investment in the sector, and a very strong amount of capital from new funds that were looking to deploy capital into new companies. In the first quarter of 2020, we actually saw dollars go up, $5.8 billion invested in the first quarter. I think a lot of that's related to the potential of these companies raising sort of their mezzanine round before going public and maybe getting out before the elections in the US. So I think there was a lot of big deals that happened. But again, a lot of capital in the market, and it was getting invested into a lot of companies. Next slide, please, David. This slide sort of gives you a sense of overall by indication on the top where these dollars were going. Of the $15 billion invested in 2019, 5.6 was invested in oncology. So oncology really dominated companies in terms of overall investment, even though Series A oncology deals were down a little bit. We monitor what we call these private mezz financings by top crossovers as sort of a predicate of what we see as IPO sentiment. And just to define crossover from my perspective, it's a publicly minded investor that are opportunistically investing into private deals. And so when we look at these deals between 2017 and 2019, there were 137 unique companies that raised these top 15 mezz rounds. And of those 68, so 52% of them went public or were acquired. And actually, I think 66 of them went public, and there were 2 acquisitions. But what was really interesting is the pace of mezz round into IPO. In 2019, there were 45 unique companies that raised these types of $40 million plus mezz rounds from these top 15 crossovers. And of those, 31% had a mezz round in 2019 and went public in the same year. So we're seeing 6 to 9 months from the mezz round completion into public market. And so a lot of good activity. The Q1 update here, which I won't spend too much time on, but there were $1,700 million plus financings in the private venture market in the first quarter. There were only 27 for the whole year last year. So there were a lot of big deals in Q1, which really set us up for what we thought was a record year prior to COVID-19 and the pandemic we find ourselves right now. Next slide, please, David. This sort of gives you a sense of how I define the investment world. You have venture capital on the left, corporate in the middle, crossover on the right side. And really, I think the takeaway here was there's not a lot of change over the last couple of years in terms of who the most active investors are. And just to give you a sense, active investor for me is these are new investments for those venture firms. These are new portfolio companies that are adding into their overall portfolio. So follow-ons, we don't really count. We're just looking for new investments into new companies. And I think, one thing to note on the crossover and late stage investors, those are kind of made up of a combination of hedge funds, sort of quasi venture funds that have a lot of different funds that they manage, as well as some private equity and family office. And
I'm sorry, could everybody please mute your line? Somebody's shuffling papers. Thank you.
And then, David, let's go to the next slide. And just to give you a sense of how I think about these crossovers and what they sort of mean for the community, is, there's a lot of activity from the crossovers, and what they're doing is, and I think there's somebody who's still on the line who's making some noise. If you could put yourself on mute, please.
Yeah. Is there somebody, Heidi? Could you please mute your line, please? Thank you.
And so, as you look at this deal, this is a really interesting slide for folks who are contemplating these mezz rounds to understand what the differences are. What you're seeing is a step up from the venture round into the mezz round of about 1.8 to 2x. And then those companies are actually also getting a step up in terms of valuation from that mezz round into the pre-money IPO. So you're seeing a lot of great activity in this sector. And frankly, the mezz investors, while they are having a higher valuation, and when they get in, they're also still getting a step up. So they're getting a lower price than what the IPO is typically pricing at. Plus, they get an allocation in that IPO to invest as much as they'd like. So let's go to the next slide, please, David. And just a sort of an overview of what we're seeing in the market here. David, can you go to the next slide, please? David, can you just advance it? And so I think we're waiting for it to be advanced. And what I did was sort of give, oh, here we go. Just an overview of where we see the market now in terms of investment. And I want to make sure we're staying on time. But the current deals in process as of the end of Q1, what we saw is that most of those deals ended up closing. The ones that were at the 1-inch goal line to the goal line, they ended up getting done really at the valuations that had been contemplated prior to. In terms of new activity, what we're really seeing venture and other folks that are investing in private venture-backed companies, they're really trying to assess their current portfolio. Which companies have less than 12 months of cash? What's the plan B? What's the plan C? How do you think about clinical trial delays? Because there will be delays out there. We're also seeing some dry powder issues with some of these Series A, because the mezz rounds have been done so in such a predictable way over the last couple of years. We have seen some Series A investors sort of overinvest in Series A and under allocate in their dry powder, which actually could be an issue going forward. And it may actually mean that there's less deal activity in their current fund and may have issues in their previous funds in terms of supporting these companies. But the folks that are doing new investments now, at least right in this Q2, are really sort of doing barbell. If you do have the ability of investing in the public markets, a lot of those folks are putting dollars to work in public deals, because you have 240 new IPOs just since 2014. That's a lot of potential opportunity for looking for value deals out there. But if they're not doing that, they're doing the preclinical Series A, because these deals allow these companies to, frankly, put their heads down, work on preclinical, and not have to worry about clinical trial delays for 6 to 8 months, 9 months, 12 months. Poke their head up and then see what the new landscape looks like. Valuations, I think seed valuations shouldn't be affected too much. Series A, there might be some valuation pressure in the $15 to $30 million rounds, especially as well as on the $50 million rounds. But I think there's actually going to be less $50 million rounds than we've seen in the past. And I do think the smaller Series A deals are going to be more the norm in the next few quarters, and that may mean that 1 or 2 syndicate members get pushed out, because in the end these venture investors are really looking for 15% plus ownership at the Series A. On the Series B mezz side, there should be a lot more smaller venture-led Series B. Typically, these Series B over the last few years have been mezz rounds of $50 to $100 million. I think we're going to see a lot more venture-led Series B deals. The step-ups aren't going to be as big, because these are really venture investors that are looking for a little bit more valuation is a little bit more important to them, but it does keep private M&A and mezz round optionality going forward. Some crossover deals will be done, but I just think it's going to be less than what we saw in the past. And sort of the silver lining is that a lot of new funds, Arch, Flagship, Venn Bio, Deerfield, all those, they raised $3.3 billion alone just in March of 2020. Could you go to the next slide, please, David? And I know I'm sort of running short on time, so I'm going to run through these next really quickly on the exit side. You know, what did Q1, 2020 look like? How has IPOs performed? And then what where do we see things going in terms of the end? But maybe we'll stay on that one and come back to that one at the end. Next slide, please, David. When you look at overall exit activity, you can see that, a lot of IPOs over the last few years, and that's sort of the dark green number there, 50 IPOs in 2019. We're seeing less private M&A, which is the light green up on the top. And that's really because so many companies have gone public at early stage because the optionality is there and the valuation is very strong. So actually most of the M&A that we're seeing for early stage companies is really being done more in the public market than the private. But the exit values really have been spectacular over the last couple of years. Can you go to the next slide, please, David? So M&A, when you look at the private M&A landscape, you're really looking at about $250 million up front with another $350 in total deal value as the median M&A deal values for private deals. What's really startling is, the deals from a Series A to exit for the ones that do get acquired, it's only 2.9 years, which is an amazing statistic. But of those companies, typically those companies are raising about $50 to $60 million in total capital. So 60 million in, 250 out with another 350 in milestones is pretty good. That's 4x up front with an 11x potential out there. 9 of the 14 deals we saw in 2019 were preclinical phase 1. And that's really been the theme over the last 3 or 4 years is more than 50% of these M&A deals are super early stage preclinical phase 1, typically in oncology or in a sort of a platform technology that's super early stage. Next slide, please. On the IPO side, what we saw is an amazing upward trajectory over the last couple of years in terms of the pre-money valuation of around $290 to $300 million. And when you see the 250 up front for private M&A, there's a reason why people are going public. You're going public at a higher valuation, you're raising $80 to $100 million, and you're advancing your assets and hopefully continuing to develop these and see a good outcome. But in Q1 of 2017, the pre-money valuation swelled from 330 million in 19 up to 560 million. And they raised $180 million in terms of the median dollars that folks raised in the public market of those 7 IPOs. Just an amazing statistic. These, to give you a sense of these companies, 5 of the 7 were preclinical or phase 1. 4 of the 7 had already raised at least 200 million in the private market. So you're sort of seeing these are all sort of crossover backed, big, Series B and Series C companies right before they go public. And even of those companies, they've done actually pretty well in the market. So if you go to the next slide, you can see the performance in the aftermarket. So even in first quarter where you saw a lot of really, obviously some strain in the financial markets and tough activity, the Q1 2020 IPOs actually were up 17% on average. And the median was plus 6%. If you look at 2019, even factoring in the first quarter, those IPOs are up 47%. And and if you look at 2018, those numbers are red. But if you factor in the couple M&As that I didn't use in this analysis, which is like Armo Bio and Synthorix, they were up about 413% amongst the 2 of them from their IPO price when they got acquired. Those numbers are green as well. So companies are doing really well. And frankly, of all the deals, we've seen 4 IPOs in the second quarter of 2020. 3 of the 4 are up over 70% plus post IPO. And then go to the next slide, please, David. This is the final slide here, and we'll get back to more of the discussion. But when we talk about the crossovers, they're such an important part of the ecosystem to sort of drive these companies into the public market. And the question really is it make sense for the crossovers to continue to invest in the private market? Because they're kind of opportunistic investors. If the public market's not looking good, they're not doing the mezz rounds. But you can see some of these crossovers, and Perceptive is one of these with really good numbers, by the way. And you look at the performance, just if you look at the IPO since 2017, that they were involved in the MES round prior to IPO, and assume that all of their holdings were equal, there's a lot of green here, which means performance has been really, really good. And they're not forced to leave the market at all because of poor performance. Their discussion really is the public market more exciting than the private market right now for MES rounds? And looking at the three of the four IPOs that have happened in Q2 and the good performance, I think it makes a lot of sense for them to continue to invest in MES rounds. And you can see over to the left, there's 5 different deals that were done right at the end of Q1 into Q2, $100 million plus deals that have those top 15 crossovers as a part of those deals. So I think IPO sentiment continues to be really strong. And I'm actually pretty cautiously optimistic as to where we are in the market. So Mostafa, probably went a little bit over my 10 minutes, apologize for that, but hopefully that gives you a sense of where we see things going in the market. And I'll sort of turn it back to you now.
Thank you. David, you can stop the slides now. John, you brought up so many issues that we probably can spend next 2 hours discussing those. But one of the things that I want to bring up as a follow-on, and I welcome other panelists to jump in as you talked about steps up, all that stuff. One unique characteristic that this financial, for the lack of a better word, financial crisis that we're going through is different than 2009 and the previous one. As you can see, the public market, although had a small decline, but it's recovering much faster. And usually when the crossovers get into the biotech investment, those are the leading indicators are overheating the market, therefore requiring some kind of corrections. All the data that you shared is very promising, shows the momentum coming into this. And the question is, on the private side, setting public aside for a different discussion, on the private side, do you think this momentum will carry over for the rest of the year?
I think we're going to see, Q2 to me is a wait and see quarter. I think everyone's trying to get a sense of where things are going to go. But I think overall, maybe you're going to see, maybe a 30% decline overall in biopharma investing, which again is a pretty small decline in the overall assessment of the dollars coming to the sector. But my perspective is, and I'll let the investors chime in too, but almost every venture fund that's out there that is active has a new fund under their belt, and those folks are long-term investors. While they understand that there's going to be fluctuations up and down in the market, they do have these sort of 8 to 10 plus year life cycles, and they know that there's going to be fluctuations within it. But their task from their LPs is to put that money into really intriguing companies that are going to provide good returns. So they are incented. In fact, they have to invest into new companies. So I think we're going to continue to see pretty good investment into 2020. We'll see where things go, but I'm again cautiously optimistic that you'll see a little bit of a downturn overall in dollars deployed, but it's not going to be falling off of a cliff, maybe somewhere around 30%.
Thank you. Now, I'd like to pose the next question to Colleen, because she and her fund is one of the biggest investors, most active investors in this sector. When you look at evolution of capital market and what we have seen and what we could be seeing, how does a VC such as yours is reactive to this market? How do you advise your existing companies as well as those in the pipeline that you are in due diligence with?
Sure. Yeah. So I think this is where we have the benefit of being a fund that's been around for a really long time. So as I said, when I introduced myself in Canaan, the firm was founded in 1987. So although I've only been there for 6 years, my colleagues and the firm as a whole have been through up and down cycles in the markets over a few decades. So I think we, as I imagine every other investor, when things first started to get very uncertain 7 or 8 weeks ago, took the very prudent approach of immediately prioritizing our current portfolio. And by that, I mean really reflecting on what we had reserved for each company and doing analyses to make sure that we have sufficient capital to support the current portfolio if times are tough for an extended period, but then also very frequent interactions with the leadership teams of our portfolio companies to help them manage through this situation. And I would say that, we're fortunate that many of our companies were very well financed and I think are built in such a way that they will be able to weather through this. But I do think it's variable, and we are a fund that has both tech and healthcare. So I have the benefit of seeing a very wide range of companies across different sectors and subsectors. And while this is, as you might imagine, an incredibly challenging time for many, many businesses, it's also an opportunity for some other businesses. So on the tech side, we have investments in things like software that enable folks to work remotely, and robotics and things like that, where I think the new normal provides actually a very interesting business opportunity for them. On the biopharma side, we have seen that our companies, while they've had to close internal company labs and clinical trials, have certainly been affected. CROs have remained open for business in other parts of the world. And although there's a bit of a delay, the companies have not been completely stalled. So, we took the approach of supporting our current portfolio first and foremost, but we are still actively investing, and we're trying to adapt to the new way of doing things, which is everything over Zoom. But I will say that we just closed on our first investment. It was on the tech side, where the entire process, start to finish, was done remotely. We had never met these founders in person, and the initial interaction came over Zoom. On the biopharma side, many of the companies that we've been talking to, we had been interacting with prior to the shutdown. So we had the benefit of having met folks in person. But I think, as we move forward, it's something that we're adapting to. And we will continue to scrutinize plans just the way we always do, and try to understand where companies' activities might be delayed. But we are still actively investing. And I, like John, have a pretty optimistic view of the environment in general. So while I'm aware of a few financings that were disrupted at the beginning of the stay-at-home recommendations, or early in March, when there was a lot of uncertainty, now I think actually folks have embraced the uncertainty. And I've seen plenty of financings get done. And I agree completely with the point that because we're coming out of a time when VC funds were really flush with cash and are in a position to continue to deploy that capital into new companies, we will continue to see new financings get done. And that's certainly, what I'm seeing currently in the market.
Thanks, Colleen. I think some of the numbers that John mentioned, like 52% IPO and M&A in one sector within one therapeutic area, these are very, very unusual times. And I think maybe this is a wake-up call to bring sanity in some of these efforts. John also showed the data that on the both investment and the M&A deal, oncology deal has been on the top. This is the case for several years now. And always anti-infective has been set aside as a small players. Do you think your views have changed with the evolution of what we see in the clinical demand toward less antiviral, either therapeutics, diagnostics, or vaccine strategy?
So I think this will be something to watch, and we'll have to see how things evolve. Where we invest and where most of the funds like us invest is really dictated by the areas that we're seeing M&A and IPOs happen. And so I think there's a lot of R&D activity going on right now to address COVID-19, which I think is fantastic. And I'm really proud of the efforts across our industry as a whole. But I think it will take time to play out and see if those areas are rewarded in terms of M&A and IPO, and that will trickle down to the venture funding.
Thanks, Colleen. I want to turn attention to Chris. Before I ask you a question as an investor, Chris, you have been an executive, very active, both in the big pharma and the startup, and you are sitting in Boston/Cambridge area. Can you share with us the feeling and what's going on in the mind of early stage startup CEOs at this point?
Yeah, I think it really depends on what their balance sheets look like, how much runway they have. I know our own portfolio companies, the first thing we did was look at, okay, can we still meet the milestones even with delays related to COVID? And are we going to run into a problem of running out of money before we hit those value inflections? So I think a good CEO of any company is going to be doing that. I think that's on the private CEO side. On the public CEO side, I think it's similar. It's how healthy are their balance sheets? Where is their stock price relative? I mean, I think we've seen a lot of resiliency in the biotech sector. I think it's not really traded down as a sector from before COVID. I think the smart companies are going to make sure that if they haven't gone out and shored up their balance sheet, that they should be doing it now. And so overall, I think we're fortunate in being in a sector that has seen some resilience through this, partly because a lot of companies are mobilized to help solve the COVID problem, but also I think it's a realization that we're not the airline industry or the hospitality industry, or and that people still need good technologies and therapies beyond COVID. And so I'm hopeful. I think John mentioned a lot of the larger funds have recently closed their recent private funds. So I think there's a lot of dry powder. But I'd like to talk to another issue related to all of this, which is I think there's really two markets we need to talk about. John did a great job of highlighting the biggest and most successful funds. And if you think about the last 5 to 7 years, there's been a little bit of a formula, right? You have maybe a dozen or 15 blue chip private funds, VCs, where that's all they do is private investment, and they have a good brand and they are good at attracting a good management team. And so you have a top tier large VC that creates a company and recruits a top tier management team, and they're knocking on the doors of the 15 or so top tier crossover funds to take the company public. And the ability to make money with that formula has been very strong and thriving. I think a lot of your audience, though, are the entrepreneurs, the ones who aren't, getting their company funded by, the large VCs. And I think that is a different model. And one of the reasons that I joined Perceptive, which is one of those top tier crossover funds, is that they really like this more efficient, virtual collaborative model that I started with Xontogeny. And that is that we were seeing a lot of overcapitalization of early stage biotechs. There was a lot more emphasis on a big narrative story around platform discovery and less about how do we get the lead asset into the clinic and through a clinical proof of concept study. And frankly, these were not, the models I described were not very friendly to founders and early equity holders. They typically get diluted with a $50 million or $80 million or $100 million Series A round. And we said, let's be smart about early investment, and let's try to find ways to do Series A investments that are 10 million or 15 or 20 million, where we can actually advance the program. And so I think that I don't begrudge those large funds. I'm glad they exist. They're solving some big problems, and they're taking a lot of risk with those large pools of capital. And I think hopefully if they bear out, it'll be good for the industry. But I think there's a lot of opportunities out there and a lot of early stage companies that, really don't need a $50 million Series A round. And that's where we've tried to focus our efforts.
Thanks, Chris. I think as you alluded to, there are some funds when their round of fundings of over $1 billion, they are looking for launch Series A. Look at NEA, for example, the most recent fund they have raised. John, before I ask my next question, do you have any comment, feedback for Chris before I go on?
No, I think Chris hit some really important points, and it's kind of tough because you see so much capital being invested into the sector that it seems like funding is quote unquote easy, but it's anything but. I think to his point, the vast majority of the Series A deals that we've seen over the last couple of years are all sort of internally generated within those 10 to 15 top Series A investors, where they're finding the technology, they're finding the management team, they're putting together these financings, and making sure that they're taking the significant portion of the company right off the bat. So it is a little bit harder for the early stage folks who already have a team together, already have sort of a business plan they're working on and looking to get funding. But I will say, what I have seen, and to Colleen's point as well, is you're starting to see some of these bigger firms to have a more of a focused seed initiative where they are putting smaller dollars into teams to see if they hit whatever experiment they need to do to maybe unlock a bigger Series A down the road. So we are starting to see a little bit more activity on the earlier stage side for some of these firms, but it's a difficult time. And I think, Q2 is going to be even more difficult just because, to everybody's point, you're looking at portfolio, you're trying to understand to make sure that your companies that you've already invested in are doing okay. And you really don't know what the new normal is going forward. And I think, through this quarter, hopefully we'll get a little bit more clarity on that, but it's a tough time.
Thank you. Chris, back to you. You saw from the data that RA Capital, Perceptive, and Deerfield are a big crossover, but that's a fresh air that Perceptive is putting some money in the early stage startup, especially in your approach, which is quite unique, that you invest not only by bringing investment, you bring a lot of other things to the table in terms of formation of company and management team. Can you elaborate on that?
Yeah, well, look, I think we play to our strengths, right? And I've spent, more than 25 years working for operating companies and, leading corporate development and medical affairs and commercial operations for, the likes of Gilead and Celgene and being a public company CEO myself. And so when we look at an early technology, we tend to have a little bit of a different mindset. Yes, we do diligence on the underlying thesis of the mechanism of action and how does that produce a biologic effect, but we put just as much time, if not more, on the early program development, right? What is the right translational models to look at? What are the right designs of those studies? What's the range of doses or the number of leads that we want to test through that? What is the right active control? In some cases, you have multiple models to choose from. Should we do them all? Should we pick the best one? We like to look for referenceable data. So if other drugs have gone through similar models and have performed in the clinic, then we'd rather use a more, quote, validated referenceable model. So I think what, I like to say is that if you look at, and not all of them, there are, I don't want to make generalizations, but many VCs have the leadership and the partners and the managing directors who've spent 20, 30 years as investors. And that's great. I don't begrudge that, but they really rely on finding good drug development talent. And, that's not always easy to find. And it's not easy to be discerning of who's really good if they have a resume of 20 years experience and who, was just at the right place at the right time. And so we really bring a lot of that drug development expertise, which is very different than being a good lab researcher, right? You have great scientists and great research institutions around the world, right? But you don't have pockets of good drug developers everywhere. And so what we've tried to do is we say, look, don't try to do it yourself, right? Let us bring our deep experience and track record of success in drug development. And, if we do this together, we don't have to deploy as much capital. We can, be smart with, your technology, Mr. and Miss Entrepreneur, where that area well and have that domain expertise. But let's collaborate and bring our skill sets together. And we may need to deploy less capital And that's a win-win for everybody. You know, you do better because you hold more direct equity after a Series A. And we do well because we're doing efficient use of capital. And, you know, what John described, which is really relying on a thriving public market where, you know, if you can go out and have a pre-money value of 500 million, it's pretty easy to make money. But if that turns and, you know, we see similar companies that are valued on the public markets at 200 million or 250 million, then that investment model starts to break down. So what we wanted to do was to craft a model of investment and advancing programs through a clinical proof of concept study that didn't rely on this thriving macro market environment. And I'll give you one example. Our first investment was a company in the inflammatory bowel disease space. There was some early mouse data that we liked. We deployed a $10 million Series A round, and $10 million, you know, managing it ourselves virtually with a small team, got us through all the IND enabling work, a series of 4 larger species studies we did in pigs. We did submitted the IND and got 2 open INDs for Crohn's and ulcerative colitis. We did a phase 1 SAD and a phase 1 MAD study with good success. We completed long-term animal tox, and we were ready to deploy or start dosing a phase 2 study before we pulled down the Series B round of 60 million. Now, if everybody could find a way to be that efficient with $10 million of capital, I think we'd have a better industry, right? And so that is kind of what we're trying to do. And guess what? That $10 million to get the company advanced that far, that meant the founder of that company is holding more direct equity than any of peers that I know who have a long track record in industry and marquee name CEOs. Even they don't hold as much equity. And so I think by having a win-win model and scenario, we like to think that's going to attract the entrepreneurs and scientists to work with us.
Thank you very much. Moving on to Cindy. Cindy, you mentioned that Connecticut Innovation is a quasi-state funding that has a lot of very unique mandate, and it's agnostic across multiple sectors. It's not just biotech. In addition to equity, they do the debt financing. And I know for a fact, this is not a guesswork, that you have been swamped with a lot of requests these days coming. Can you share with us the landscape that you see from your particular angle as a state funding to do economic development? What kind of demand you see coming at your fund? And where do you see the development coming up in the next few months?
Yeah, thanks, Mostafa. So being a state funding agency, I don't know if it's, we do see a lot of volume. We definitely are helping facilitate people navigate the PPP program and some of the other benefits that are out there, not only for our portfolio companies, but we also handle some requests outside of the portfolio companies. From an investment standpoint, we really, have to prioritize the current portfolio, not different from what Colleen said. We support the greatest potential opportunities. It's a little bit of a stay the course. We're not rushing to fund things that may have been a sinking ship otherwise. So, the filter is getting a little bit tighter as far as new opportunities, but I think that any given portfolio, there's going to be some things that just aren't going to make it anyway. And so, were there signs beforehand? Is it truly something that we're seeing as a response or as an outcome of the current COVID crisis? Try to parse that out and try to just, stay the course, focus on the opportunities that we have at hand. I think the biggest thing that we've seen just from a new investment perspective is that one of the requirements we have is going in with other co-investors. And so we wouldn't do even a very small round on our own for a new opportunity without having at least a 50 to 100% match. And so some of the challenges that have been, finding those other investors for one, Other challenges have been just on raising bigger rounds. Some people are waiting. Companies were going to do a seed round, couldn't do a seed round. We were able to push one in particular through on a pre-seed, a lower amount, hopefully get them through the next 2 or 3 months. And then, you know, hopefully things will open up again. I think we're hopeful, like a lot of the other people on the panel, but, you know, just kind of stay the course, reactive. We're just from a sourcing perspective, it's been a little bit of a hindrance because some of the big meetings where we find new opportunities have been canceled. We're trying out, you know, some other digital formats, so hopefully that will help with the new substrate. But I can't say we're business as usual. We went through a big frenzy, you know, maybe about a couple months ago, and now we're looking for new opportunities. We still have money. We still have money in the fund. So
that's good to hear. And
yeah.
Part of the frenzy was coming from our and a lot of our incubated company rushing to ask for money. Now, CI, in addition to equity investment, has a debt portfolio, and as a result, there is a payment required. I understand that CI is making accommodation to these companies to go through these challenges. Can you elaborate on that, please?
Yeah. So we have been doing a lot of principal and interest deferrals. Most of those deferrals have been 3 to 6 months. Companies that, you know, have been going along the path, and maybe they were in the middle of raising a round and people pulled out and they're kind of stuck. So we have been doing a lot of that kind of forgiveness on a temporary basis, right? So 3 to 6 months, hopefully things will be better. We're hopeful, as I said before, yeah. But you know, we'll see how things go the next couple of months.
I think that's a very critical move. Our view toward our own companies have been the critical issue: stay in business and keep people employed. Now, those are other things can be delayed as much as possible. That's been the perspective, because we need to go through this stage so we can step back and figure out what's the right strategy before, you know, pushing too far into unemployment or going backward in the business development. Thank you very much, Cindy. To the audience, we are coming almost to the end of prepared questions. I have a few more to go through, but if you have any question, please type on the chat box, which appears somewhere on your screen, and my screen's on the right side. And once we are done with the initial questions, we are going to come back to your question. Again, if you're not, for the audience, please mute yourself, turn off your camera so you don't pop up on the screen as we go through the question and answers. So moving on to our next panelist, Maryanne Rooke, who is the president of Angel Investor Forum. This is a group of angels that cover Connecticut, and I know they co-invest with New York and Massachusetts occasionally. And I've worked with them. They are very diverse, sophisticated investors, and they are diverse in a sense of technology. In fact, they do less of biotech and more on the tech side of the business. Maryanne, I want to come to you and ask you, in talking to the investors in your network, what are their feelings? What do they think? Are they excited about this period? Are they waiting to see other signals to add more investment?
Well, thank you. Thrilled to be on this panel today. Our business, you know, we're business as usual. The only thing that's happened is that we've moved everything onto Zoom like everybody else. We have in the last, as I mentioned, we have about 50 members in our group, primarily Connecticut and some folks from New York and Massachusetts. And we've had a lot of recent activity. We had our meeting online, 3 to 4 companies present every month. Of that, we have a couple that are in due diligence. In the last 30 to 60 days, our members have probably made investments in a couple of companies. We have a deal alert out right now on one company that is a Connecticut company. As a matter of fact, it's a UConn company. that our group came to meet through the UConn Innovation Fund. And we have another company, another deal alert that's going out today that is actually a UConn tip company. So we are very active. Of course, filters of what's, it's really got to be a strong, solid company. And just like what Chris mentioned, it's the leadership team is really key for us. And during this period, we've really had the opportunity to do a lot of, and like what Cindy said, we've been swamped with requests from not only our portfolio companies, but a lot of companies that are just getting ready to raise capital. Some of them might have closed on capital, and they're really trying to scale. And this is kind of a hard time to jump into that fray. So we've been doing a lot of mentoring and advising and connecting these folks to some of the right resources. And you know, happy to say that several of our portfolio companies have already not only been approved for the PPP loans or the disaster loans, but have also received the monies. So that's really helped them through. And through this period, we've really gotten a better sense about who's really the CEOs and the management teams, who are really the leaders that are going to navigate through this kind of a change. And so, you know, some of those companies we're investing in. I would say that, you know, we're really are filtering it a lot closer. You know, investors in our arena are not necessarily taking some of those extreme risks, like, oh yeah, I'll throw a little bit of money in this because it sounds like a good idea and we'll help them just get off the ground. I can't say that a lot of that's happening right now, but if you think about it in terms of, you know, a lot of people have asked recently, well, some of the angels might be putting their money in the stock market because the stock market's down so, and they could get some quick returns if the stock market comes up. And of course, you need to understand what companies in the stock market you might want to do that with. You know, if you take that into our angel world, we really get to know these companies and these CEOs, and we understand where the hurdles might be. And with all of our companies in the UConn Innovation Fund, as well as with Angel Investor Forum portfolio, you know, we have surveyed them, been working closely together with them to understand how they've been impacted by the COVID-19 and economic situation that we're in, and help trying to figure out how we can help them make all the right decisions and strategize for the next steps forward. And several of them have also had some unique opportunities presented to them because of the COVID-19 scenario, and they're capitalizing on it. They might be pivoting and putting some of their resources on doing some COVID-19 antibody tests or things of that nature. So I won't say that it's you know, totally business as usual, but we are very active in our fund, AIF fund. We've just made 2 investments in companies in the last 45 days. We have another one that we're voting on as we speak that went out to the poll to our AIF members today. So we are seeing, you know, a lot of activity, and hopefully we will continue to work with a lot of the folks. We work closely with CI. We provide a lot of the matches for some of the CI companies. And it's just a different environment, and we all are zoomed out, aren't we, after 6 weeks here of Zoom meetings. That covers you know, a little bit of what you were looking for from the angel world. But I did also want to say is that AIF, we've been syndicating investments throughout New England. We're very actively connected. All of the angel groups know each other, right? So we all know each other. We know what each other likes to invest in. We've been, for the 15 years I've been involved with AIF, we've been very active with all the New England groups, Boston in particular. And in the last year plus, we've developed an alliance of angel groups throughout New York, New Jersey, and Connecticut. And so we're seeing a lot of interesting companies with great technologies and superb management teams. So I'm hopeful that some of these companies will move up into the Canaan worlds and the Silicon Valley worlds. And I'd be interested to know how many of your companies were initially funded by the early dollars of angel groups. That's always something that we're interested in understanding.
Yeah, thank you, Maryanne. Well, anybody had comment of the panelists? I hear some.
No, I would just add that I think seed investment is important to make an early company or early technology get to the point where it becomes more investable. But I'd also say, make sure you understand, how to deploy that capital, that you're using it smartly, and that you're really de-risking the company. Because I've seen too many entrepreneurs, they cobble together a nice seed round and they don't bring enough value. And people say, well, I'm sorry, I know you invested $500,000 or $2 million, but I don't see how we can invest at this point. And so it's important to get a lot of feedback. If you have a $500,000 or $1 million, how do you deploy that capital to have the biggest impact to make other investors more excited to come in? And again, we try to work with folks. We can invest from a few $100,000 to $1.5 million or more in a seed round. And that's what we focus on, is how do we do this in a way where we really feel it's going to de-risk the technology.
Thank you. Maryanne referred to UIF, which is a fund, has 3 LPs. The one is university, the other one is Connecticut Innovation and Webster Bank. And that has been a good catalyst, I would say. It's not the first money in the companies, but has been a catalyst to get some proof of concept data for the companies and acquire the first customers. With that in mind, again, all the panelists are welcome to make comment as we go through. I'd like to switch to some questions that I see coming from chat. Don and I will ask, we screen those questions and pose it. Everybody can see those questions. One question that came up, and I noticed Chris and Shubha, you already answered that, but I want to bring it up for the general audience, that if the US VC funds invest in Canadian company.
Yeah, I think we answered it on the chat that we announced a Canadian investment, $20 million Series A round in a company called Zucara in the cardiometabolic space. And we've also have not announced at this point, it actually has a COVID potential, but it's a point of care diagnostic that we invested in as well out of Canada. I was actually on 2 board calls last night, both with those companies from Canada. But I think the main thing is that we are agnostic to wherever the technology comes from and wherever the company is based. So we like, it's funny with COVID, we're doing more virtual work and more Zoom calls. We think that most early development, unless you're doing lab work and you have 30,000 square foot of lab space and you're doing that early discovery, once you have a lead compound or a lead technology, a lot of that's outsourced. And we don't mind working with companies that are based, honestly, anywhere in the world, but anywhere, in North America, it's very easy for us to facilitate it. So I'd say, and Colleen can weigh in, I think most of the firms are willing to invest in good technology, regardless of where it comes.
Thank you.
Yes, absolutely. We're willing to invest in, outside of the U.S. as well. I will say that the majority of our investments are in the U.S., and that's because it's easier to develop relationships, and we're very active investors, and it helps to be close to the companies. And there's been no shortage of opportunities here. However, we certainly have several ex-U.S. investments right now.
Thank you.
Just a quick comment, I guess, from Connecticut Innovation standpoint. Although we have a Connecticut presence agreement, we do have investments in some companies that maybe started elsewhere and then agreed to set up headquarters or something else in the state. So it's not totally off our plate, but you know, you would have to have some sort of a Connecticut connection. Thanks.
In fact, Connecticut Innovation had a process called Venture Clash, which was a global business competition. And the first top winner from that was a Canadian credit card processing company that received the funding. As a result, they established some footprint here in Connecticut. Is Nahid Kurji on the call? I'm hoping that he's a participant. He is the CEO of Cyclica, based in Toronto, that just closed the Series B led by a US VC. So that there are a number of examples of these scenarios. I think VCs collectively look into the quality of the idea and the management and the market in that regard. Don, do you have any question that you want to pose to the audience?
Sure, thank you, Mostafa. First of all, a lot of comments have come in to the panelists saying what a great job you're doing, and they're finding a lot of value in this information, so thank you very much. There's a question here. What non-financial parameters can we use to measure the success of VC firms in biopharma in terms of tangible human health benefits? For example, given the long development times for drugs, are the biotech and VC worlds sufficiently old to start ranking VC firms by how many FDA-approved drugs, or at least phase 3 candidates, is in their historic portfolio companies have generated?
Yeah. I'm happy to start just with a point of reference. Last year, my mid-year report, we sort of looked at new chemical entities and where those actually started in terms of commercialization or clinical development efforts. And it was interesting because over the last 10 years, almost 50% of those new chemical entities that were approved by the FDA went through the venture realm. Those weren't necessarily venture-backed companies when they got approval, because a lot of them got acquired down the road. But there's a reason why these companies continue to get picked up by acquirers, and they also go public. It's because they know what they're doing, and they're actually getting these across the goal line. And a lot of times you don't see that because they do get acquired, and these are milestone payments that typically you just see if you're an LP and you go to the meeting of that VC fund to see that things are going in a positive direction, because a lot of times these assets get renamed, et cetera. But there has been a ton of progress in that world. And frankly, when we saw big pharma basically get rid of R and focus more on D 10 plus years ago, and we saw venture folks sort of jump into the fray and create these companies that are now the source of a lot of the pipelines for big pharma. I think you're seeing a lot of good positive feedback and success on that side.
Yeah, and I'll just add, I love John's comments on that, but also I love that question, because I think that question isn't asked often enough. And because, you see a lot of early stage investors go to drug discovery and big narratives, and we've got the next CRISPR platform, and it's worth $2 billion because it'll transform medicine, 10 years from now, and we're a few years from the clinic. And again, that's the job of, VCs, is to serve their investors. So I think, but I think one thing that has been true for the 40 plus years of the biotech industry is that nothing beats a clinical proof of concept study, data set that's positive, that everybody looks at and says, wow, this drug is going to get approved. And I think that there's a lot of ways to make money without producing that definitive clinical data set. And I think it would be nice if, you looked at a correlation, because I think you can make a lot of money on companies without doing that. And sometimes the companies that do that, they still make money. They may not make as much as some of the earlier stage platform companies. So I think it's good to take a look at track record, not just through the lens of investment success. If you're an investor, that's important. But as an industry, I think we need to look at, who really understands how to do drug development and get drugs, that are ultimately approved.
Thank you. Maryanne, two questions. I'm going to combine it in one for you. One is, what's the typical check size for AIF for the angels? And the second part is, are companies, small biotech companies, including publicly traded companies, are they eligible for angel investor tax credit?
Well, the first question, the size of checks. If it's a Connecticut company, our angels want to take advantage of the angel investor tax credit. So they're writing checks of $25,000 because that's the minimum in order to take advantage of the angel investor tax credit. And I would say in general, there's some companies might take 10, but a lot of companies don't want to take, have a lot of folks on their cap table. So we'll generally 25,000 and up is the general size. And then of course, through our fund, we make a lot of our recent investments have been 50,000. In our earlier funds, we might have made, 100,000 in investments. So the funds have a little bit more flexibility as to what they choose to do. As far as available companies that could be eligible for the angel investor tax credit, I believe that if you get onto the CI website, Connecticut Innovations website, there's a list of the different types of industries that would be covered and eligible for the angel investor tax credit. And they have to be a Connecticut-based company. And it could be biotech, yes. I know that our group, AIF, we've invested in companies just in the recent couple of this past year, biotech companies, medical device companies, and they are all, we've received the angel investor tax credit there. Public companies, I don't think, we'd have to verify that, but public companies are much more, much larger, and some of the criteria for the angel investor tax credit is that they have to have received $1 million or less in revenues. So public companies wouldn't necessarily fall into that category.
So to the question regarding nanoviricide, because nanoviricide doesn't have a revenue, at least from that perspective, I think that might be eligible. Don, do you have any questions?
Just a quick comment on that. Mary mentioned that it was on the Connecticut Innovations website because we manage the program. And so if anybody does have specific questions about the Connecticut Angel Tax Credit, feel free to email me and I will hook you up with our expert at CI. Happy to do that. Thanks. Go ahead, Dawn.
Yeah, how much interest is there in investing in COVID-19 antiviral technologies?
Yeah, it's funny. I was typing a response because I wasn't sure if we were going to get to that question. Look, we've clearly seen an uptick in pitches for COVID-related treatments. Oftentimes, though, these are pivots. They haven't had success with their technology, with the original program, and so they think that COVID, in other cases, it's going after related, pulmonary, disorders and how they could leverage the COVID opportunity. I think this is a tough one. On one side, you've got more FDA flexibility. Right now, you've got a lot of patients. You can do quick and efficient clinical studies and get a quick read. But it's also incredibly crowded and very competitive. And you just don't know who's going to produce a data set, that raises the bar on treatment. So I think if you're not ready to move quickly in submitting an IND to the FDA and getting into one of their, protocols, I think you have to be very circumspect of, how revolutionary is this And, are we going to look back a year from now and say, wow, there's a lot more, data sets, a lot more products that have received approval. And gee, we wasted a lot of time going after this. So it always feels like the urgency that is now, you have to really fast forward. What's that going to look like a year, 18 months, 2 years from now?
Thank you. Anybody else want to add to that?
I'll just say I agree with everything Chris just said, and maybe I'll just say our due diligence criteria haven't changed because of COVID-19. So if the opportunity meets those criteria, regardless of the current crisis, then we're interested, and if not, then it's just not a fit for us.
Yeah, that's Colleen. I was going to jump in and say that exact same thing. I think, it's interesting, especially if there is something that has a, solid scientific rationale that, looks like it could be, something that's doable near term, that it's not, solely a pivot and, a company maybe just trying to, rake in some extra dollars because they have a COVID application, but it's got to pass muster from a diligence perspective as well. So I think the mad rush is not something that at least, we've wanted to jump on board with.
Yeah. There is a long questions that you can read is about dry powder, the mismatch of the valuation and the public market. And I think, John, you might be in a good position to answer that question. So in a typical market crash, when public market crashes first, and then it creates imbalance of the asset class in portfolio of investors, right? VC assets are considered as a high-risk asset. Typically, funds try to allocate maybe around 6 or 7%, but when the public market crashes, that balance suddenly changes. We haven't seen this today yet. There was some jitter in the market, but the drop is not significant to cause that issue. So John, looking at your crystal ball, what do you think would be the reaction? Do you think that the LPs are going to reduce their appetite to put new money in the new funds?
Well, I think we saw a little bit of that in 2008 and 9 with sort of the rebalancing of the percentages that they're allocating to their asset pile. And we did see a number of venture firms that did struggle and weren't able to raise new funds during that period of time. Although that was, in a significant downturn that affected all sectors, including healthcare, quite a bit. And we just haven't quite seen that. And the question is, will we see that? And nobody can see that in their crystal ball yet. It's been amazing to see the ability of biopharma to sort of tread water right now, and to then see in Q2 IPOs go out and do extraordinarily well. But we'll see where things go from here. I do think that valuation in my mind has been, at least through the venture and the mezz round, been driven by what people think the public markets will look like and what the public markets will bear, and the pop that you're expecting after the IPO, and the ability of those companies to then get acquired at a huge premium in the public market based on good data and a lot of scenarios that we've seen over the last couple of years. And in a downward market, I do think there's the issue of having to reprice if you can't get into the public market and you have a valuation that maybe is not supported by the development stage of the company. I do think that all kind of factors together. And in essence, while there could be some pain there also could be more buying opportunities for big pharma, because as we had sort of talked about in the beginning, they've outsourced their research for the most part, and they are looking for early stage companies to add to their pipeline. And then I think so the values may not be maybe as compelling as we saw over the last couple of years, but they're still going to be there. And for the companies that might not be able to get public, maybe a 1.5 to 2x is okay up front, versus what typically is a 3x plus you need even to think about exiting early. There may be a little bit of a new reality, but in the end, I think you do look at venture funds themselves, you look at the long-term perspective that they add and they look at, they know that there's going to be up and downs in the cycle, and they just have to figure out how to create as much optionality as they can to take advantage of those upswings as well as the downswings. And if the downswings mean repricing at different valuations, but continuing to support the companies because they believe there's going to be value created in the long term, then that's going to happen. But yeah, it's a tough crystal ball to look into, but those are just a few of my thoughts. I think we're still looking pretty good for biopharma.
Easy question to answer, tough to, easy question to ask, but tough to answer here, especially when it comes to the step-ups and the valuation. We are coming close to the end of our program, and I want to go around to all panelists and give them the last words here. Essentially, if anything that you want to say, word of advice, observation, very briefly. I'm going to start from the reverse sequence, starting with Maryanne Rooke, please.
Thank you. So I guess one thing I did want to share with you is when you did ask about the size of investments. Now, individuals, just so that folks truly understand the angel world, we're writing checks out of our own pockets. So when we write checks, it's through our angel group, it's individual angels. But we also, each angel group probably will bring several $100,000 to a deal. And that's why we syndicate with Connecticut Innovations, all the angel groups throughout New England, so that we can bring a couple of $1 million to a company. We lead some deals, but we syndicate on many more. Through that process, I do want to, any of the entrepreneurs that might be listening, is that they should go to our website, Angel Investor Forum, and apply through there. It's best to have a champion, if you will, to get through our process, because there are some great entrepreneurs, a lot of great technologies that they're developing in our region, and we would love to increase our deal flow. And of course, we want to be able to build up some of these companies so that we can lob them up to Canaan and Silicon Valley Bank, so that we can have, some of those big exits. We certainly, our angel group a few years ago brought $1 million, just our angel group brought $1 million to one deal. Within 4 years, we had an exit. It was one of our own angels was one of the co-founders. And so again, we might bring only a few, 25, 50, 100,000 to a deal to $1 million. So it really depends. Would love to, connect up with anyone that has more questions about Angel Investor Forum and how we do business. And thank you again for joining, for having me join this.
Thanks, Maryanne. Thank you very much. Cindy, please.
Yes, thanks. I guess just in a nutshell, Connecticut Innovations is still looking for investments. We would fund anywhere on a pre-seed up to usually 150K. And then if we were doing a bigger round, it might be 1 or 2 million. We can lead, we can help with that. We do look for strength in the management teams. We look for market impact and a technological advancement. And then we can help. We usually take a board seat. We can help from an investment connections and advisory perspective. So look for me on the Connecticut Innovations website. Thanks. I know we're short of time.
Yeah, well, I can attest to what Cindy said. They are very hands-on. Although they act as a VC, but their intention is helping entrepreneurs to get it started and moving forward. And they use their credibility and network to create really outstanding syndicates that adds more value to their participation. Chris, go ahead, please.
Sure. Yeah, just to echo, I mean, look, John said it earlier, even if we saw a 30% decline in private investment, this is a healthy sector. There's a lot of dry powder out there. There's a lot of interest in moving forward new technologies, maybe more of an appreciation, post-COVID. So all the entrepreneurs that are thinking it's a horrible time, I would disagree. We are actively investing. We've closed on a recent Series A. We're about to close on another one soon. We've done a couple seed investments to bring into the accelerator. So yeah, I think it's we're always going to have ups and downs. And so we have to expect that. That's the natural cycle of any sector. But I think this is an industry that is very resilient. and is going to thrive, through this. So I encourage everybody to keep an optimistic view.
Thank you. Just for the record, Chris has $210 million fresh money, and he's itching to spend it.
Fair enough.
Colleen, go ahead, please.
I echo exactly what Chris said. We're fortunate that in the biopharma space, we're coming off of some of the most exuberant times, and there's still a lot of cash out there. So while this is an evolving situation, I think you heard from many of us, we're waiting to see how things play out over the next few months and maybe even few years. I remain very optimistic and have seen a number of financings continue to get done, and still seeing a lot of great companies come in for first meetings. So have a very positive outlook today. Thanks.
Thank you very much, Colleen. I am biased toward Canaan because they are neighbors, and many people see the press releases as Canaan invests in the companies. What they don't see is the value they add to the community through their mentorship and a lot of guidance that they provide to a lot of entrepreneurs. And I want to acknowledge that, and we really appreciate it.
Oh, thank you for the kind words. Appreciate it.
So now to John, who opened the can of the worm. It's all on your shoulder. Fix it.
Yeah, no, I don't think I can fix it, but yeah, this is a great panel. I enjoyed hearing from all the panelists. As I said, the slides that we put together, we do our best to sort of see what's going on in the market and then apply that in a forward-thinking way. Those are all sort of my predictions. On conversations with investors as well as my colleagues. So, take it with a grain of salt. But if it's helpful, please feel free to use it and leverage. And the slides will be available. And it was great to talk to everybody. Again, I agree with my panelists. I'm cautiously optimistic. There's going to be some near-term slowdown, and I think it's just as everyone tries to figure out what the next path forward really looks like. But I don't think we're going to see a major significant slowdown in the pace of innovation or the pace of investment within the biopharma community. So
thanks, John. I want to thank the panelists. You heard a lot of details of nuance of investment and the strategies they have in mind. But one thing that I think we all got out of this conversation, the positive and upbeat views that investors have in this market. This is really, really exciting, promising, and encouraging for the entrepreneurs and CEOs. And we look forward to working with you. Once again, thank you very much for taking your time spending with our audience. And we will look back. I'm hoping that a year from now, when we look back and we find out some of our fears were really, really unwarranted and things were not as bad as what we were anticipating. And I look forward to that. With that in mind, thank you very much. And I'm going to pass the baton back to Don Hosevar.
Hi, thank you, everyone. I just echo what most of the attendees have put in the chat box, that you all did a phenomenal job. The information was very valuable, and BioCT thanks you. We thank Markham. We thank Advanced CT. We thank Mostafa for being an excellent moderator. And we are going to have a recording of this available, and we also are going to be sending each of the attendees a survey, and we appreciate any input and feedback you'd like to give us. So on behalf of BioCT, we thank you very much for attending today's webinar. Thank you.
Thanks, everybody. Stay safe.
Stay safe, stay well, stay home.